Fixed interest is a great asset class. It provides a steady income stream for investors. Secondly, it's a great diversifier in your balanced fund. So generally speaking, when equity markets sell off or have a market meltdown, fixed income performs very, very well. So it's a great sort of balancing act, if you want to view it that way. And it's the defensive part of your overall balanced fund. And then finally, if you think about volatility of total returns, fixed income is much lower in volatility relative to equities. So fixed income would have about 5% volatility on average per annum, whereas equities will have anywhere between 15 to 20% volatility. So much lower volatility relative to equities.
Basically, a lot of people have a lot of risk within their normal diversified portfolios. Equities, property, those sorts of asset classes, which generally in the good times do well. But clearly, when things aren't going so well, you do need that diversification, which is what bonds provide. The way to think about fixed income is generally you're locking in term interest rates, which you will earn through the life of the security, even if cash rates are coming down.
So in Pendal's income and fixed interest team, I'm so excited to be on this team. We are a collective group of people who have come from such different backgrounds.
Yeah, so we have a large team of 10 investment professionals. If you think about the 4 lead portfolio managers, their average experience is 28 years per person. So significant experience on average for the 4 lead portfolio managers. And the other important aspect of the lead portfolio managers is they're all experts in their own field.
In our team, we believe in deep experience. We don't want people trying to cover too much. To be a true expert in a particular area of the market takes a long time to get to, and you have to have a very deep knowledge of that particular field. So we adopt a strategy where there's 4 heads of 4 different areas: income, cash, credit and sustainability, and then what I do, government bonds. And all of them require that deep expertise in that particular field. So between the 4 of us and the team supporting us, we have that.
Within the income and fixed interest team, we don't run a siloed approach. We have all of the strategies that we manage within the one team. So what that means is that you're getting a better appreciation of the risks that went before you implement a portfolio decision. Within our team, obviously, we've got Tim looking at the govies, we've got Amy giving us input on what's happening in the emerging markets, we've got George giving us input on what's happening in the credit space, and we're obviously backed up by a really well-resourced team. The benefit of that is you're getting far broader insights into what's happening, and it makes for a better portfolio decision when you start to implement that. That's always a strength of ours, the siloed approach. I just don't think you get that cross-pollination of ideas and a better understanding of the risks before you implement portfolio decisions.
So my approach to risk management is all about decision making. I think without a strong decision making framework, you can't have a good risk management framework. And the biggest thing about risk management, when you talk to a lot of people, they immediately think about, you've got a position going against you and it's going wrong. And a really good example of good decision making is, before you even take a position in markets, before you even go and take risk, think about the range of possibilities that might await you on the other side. And then try and build your conviction for your original investment thesis. If you can build it, then assign probabilities behind it. And if you can build it, you can also see what can go wrong. So being prepared for what can go wrong ahead of time, and being prepared and knowing what you will do and how you will execute your strategy even when things go wrong, is all part of what I think is a good decision-making framework, and therefore a good risk management framework.
We have 2 strong focuses in our team. One is the quantitative ability of the team. We have a lot of models that we have developed and use to help us analyse markets. And the way to think of those models is we're trying to take the emotion out of the decision, and they're trying to be forward-looking. So they give us a lot of good signposts on where the economy and where markets are going. So that's the quantitative side, which we're very strong in. But of course, there's the qualitative side. And the qualitative side comes through a lot of experience. It comes through a lot of research we do. It also comes through a lot of contacts in the market. We spend a lot of time talking to people like the Reserve Bank of Australia, to people like the economics teams at some of the large banks. And also we talk a lot with our equity team. What we're trying to do is get a feel for where the economy is going.
So a big differentiator to the way we manage money at Pendal Fixed Income is our top-down process and our active de-risking and re-risking of our portfolios based on our unique top-down process. That unique top-down process combines our qualitative view, our quantitative models, and technical analysis. So combining the qualitative view, the quantitative results, and the technical analysis, basically that drives our process of are we bullish or bearish markets, and therefore de-risking and re-risking. And that, from my perspective, is a real differentiating factor relative to our peer group.
So I think one of the advantages that we have is just we're in the ideal sweet spot in the Australian market. So we're big enough that we're an important counterparty for all the counterparties that we deal with, but we're also a small enough counterparty that when we add securities that offer us additional margin, our end investors know that that margin that we're getting from those securities will feed through to portfolio outcomes. We're not diluting it across an asset base that is too large. And I think that is one of the key strengths that we have at Pendal here is our size, big enough that we're important, but also small enough that it means that our investors are getting the best result at the end of the day.
At the very institutional end of the spectrum, we talk to a number of large super funds in Australia and also a number of sovereign wealth funds. And typically for these types of clients, they're looking for guidance and for partnership for how they're going to manage the safer part or the more defensive part of their asset allocations going forward, as well as advice on how to pursue a more strategic way of thinking about asset allocation in the long term. At the other end of the spectrum, we also speak to a very large network of advisors and financial planners, and they have your everyday savers and investors in Australia's best interests at heart. And so what we do with those advisors and planners is to partner with them so that they are most likely to meet the financial and investment objectives of their end clients.
The team has a very broad range of clients, all the way from the sort of institutional client base, some large insurance companies and some superannuation funds, right down to sort of mums and dads. So we've got a broad range of clients, each with their own particular needs, and we've got a broad range of products to help facilitate those.